In this video, traders, we're going to look at combining time frames for momentum scalping using oscillators. Stay tuned. Hey traders, warm welcome to you. So this was a question, or part of this is addressing a question from a subscriber. Much appreciated, very nice email. And I appreciate all your questions and emails, and most of them are really, really nice. Some of you guys aren't so nice out there with the emails, but hey, that's life, right? But this one's a nice email. Thank you, appreciate it. Hopefully we can kind of get to the bottom of this now. So the question is, if I'm looking at trading using oscillators, if you looked at my other video, you've got the higher time frame here, and let's say you've got your RSI, so you're overbought on a higher time frame. You're looking at the lower time frame, and let's say this is the RSI, so we're overbought on here. We're looking for an oversold condition here to a push in the direction of the trend. So that's one of the concepts. There were different concepts on it. But the idea is that you've got the trend and you're looking for a counter trend move on the lower time frame, preferably oversold. So perhaps you don't necessarily have to have overbought there, but you could have an uptrend that then goes oversold on a lower time frame. And the question was, this often gives a lots of false signals while everything catches up with itself. And it's a great, great observation. And you know, this is trading, isn't it? It's trading of kind of, it's great on one hand, but it's the worst thing ever on the next, and it's challenging to find the sweet spot. And all we can do as traders, and this is why I love you guys writing in with the emails and the comments and stuff, because it makes me think about things and it makes me share things. You spark ideas up, you know, and that's the whole name of the game, right? We're about kind of learning from each other and sharing things and just improving and improving. So this is a great question. So the idea is that we're trying to get on that lower time frame back in the direction of the trend. So a couple of things to perhaps try are to wait until there is some sort of price action signal back in the direction. So use the filter of the higher time frame, lower time frame combo, but then add an additional filter in and say, okay, well, for example, let's say we're trading long on a lower time frame. Let's say we've dipped down and we want to get long on the lower time frame, whatever these filters may be. Why not then add a candlestick pattern in the direction of that? So like a bullish engulfing, something like that. You wouldn't necessarily get that on an intraday chart because of the gap situation, or maybe the three good solid green candles, or maybe that kind of wick to the downside that reverses. Perhaps adding that as an additional filter in gives you a little bit extra edge, because it's quite tempting to kind of dive in when this starts curling up. And yes, quite a great observation. Often the lower time frame will just stall and stall and stall before it really gets going. The other way is to wait until it does get going and buy a pullback. So not try and be so finite with the entry, but to wait and say, okay, well, I want to align myself with long. The lower time frame's coming down and is now curling back up. Let me now wait until I see momentum. I'm going to be late to the party, I get it, but at least then I know that I've got more chance of being right on this trade than trying to get in on that low. And there may not be enough opportunity for it. You may be, by the time you identify momentum, it could be at the high, and you might think I'm chasing it a bit. And that, that's the way it is sometimes. But just adding maybe something else into it, and something else that stops you from getting involved in the chart, because often this can kind of sit here as well for a while, and if that's oversold, this might come off overbought, and it might just go into a choppy, horrible environment. So maybe you can add an extra filter that says, okay, well, let this retrace and let's see this curl back up. Obviously, by that time, that's going to be almost overbought, but almost looking back and saying, well, how long has this stayed overbought? How long has the lower time frame stayed overbought? If the lower time frame has stayed overbought for a decent period of time, maybe I can go against the textbook here, base it on what's happened on that market you're trading, and buy it in overbought on the lower time frame. And I know people watching, going, what, I buy an overbought? Yeah, but you're looking at it in the context of what's happened previously. And if it stayed overbought quite a long time previously on the lower time frame, giving the higher time frame chance to become overbought, you you've got the edge on your side that maybe is really against the textbook, but ultimately, if that's the pattern the market's exhibiting, align yourself, plug yourself in with the pattern that the market's exhibiting. So maybe wait for it to become overbought and buy it in an overbought condition, thinking, okay, well, I want to wait until the higher time frame catches up to overbought. So there's different ways of combining it, and it is challenging. And we share stuff and we talk about, hey, this is how you do it, and I get it. It's not, there's no definitive answer. It's just often a guide of how to do stuff. The other thing that you can potentially do is maybe turn up the sensitivity of your oscillator so that your oscillator is more sensitive, which kind of seems counterintuitive, but that sensitivity might give you a chance to say, okay, well, I might trade that technique where on a very sensitive oscillator setting, I can trade overbought because it could stay overbought for a long time, and on a longer term setting, it's going to take a long time for it to wind back up. The concept is good, the concept works, but it's tweaking it, and I think it does depend on the market you're trading, the conditions you're in. If this is a very strong momentum to the upside and you've got the oscillator pushing to the highs, it's overbought, then you get an oversold in a lower time frame and it's a bull flag, you're probably going to get a good result out of it. As soon as it comes off the oversold condition and crosses back up through that oversold condition, the price action is probably going to look like that anyway, so you're going to be all over that from a price action perspective, and adding that as an extra criteria is just sort of cherry on the cake. But if this is not so aggressive, or maybe it's swinging quite a bit, doesn't seem so clean, then you're probably going to get lots of false signals with that, and it kind of pushes up a bit, pushes down a bit. That's when you add in something a little bit more specific in terms of what I want to see in the candlestick. So I want to see those candlesticks proving to me that there is momentum in the direction, something reversal is happening. And most importantly, as we always say, is trying to quantify that risk. So if we have that kind of pattern there with that tail, you can have a crack at it because you know that, hey, my risk is X, my reward is 4X or 3X, whatever it may be. 4X, you like the pun. My risk is 4X or 3X, whatever it may be. So I can take that trade. It doesn't really matter if it doesn't work because I've got this lined up, this lined up. That's okay. My risk is quantified. I'll have a go at it. Anyway, guys, combining time frames for momentum scalping using oscillators. Some more ideas to think about. That looks a little bit grubby on the board, doesn't it, when I'm looking at it? But hopefully it makes some sense. Comments in the comment section below. I'll see you next one. Take care. Bye-bye.